With several major trade deals announced so far, how should investors position their portfolios in light of these developments? As we head into the month of August, investors are turning their attention to President Trump's tariff agenda and his pressure on the US Federal Reserve to lower rates. So far, several major trade deals, including with major trading partners such as China and Japan, have been announced, which has boosted market sentiment as increased clarity will give global exporters a firmer basis for corporate planning and earnings guidance. Moreover, with the Fed anticipated to begin cutting rates in the second half of the year, and with the White House likely to nominate a dovish Fed chair to replace Chair Powell when his term ends in mid-2026, we see global liquidity conditions remaining broadly supportive over the near to medium term. These tailwinds underpin a moderately risk-on stance in our tactical asset allocation, primarily expressed via our overall overweight position in equities. Within equities, we continue to see better risk-reward in Asia ex-Japan, where valuations remain relatively undemanding with resilient earnings fundamentals. And European equities, where the prospects for fiscal easing is expected to be a significant tailwind for the region's economic and earnings outlook. And we hold neutral positions in Japan and the US. For US equities specifically, we see the long-term risk-reward as neutral, given the clouded outlook for US inflation, as inventories comprising of front-loaded pre-Liberation Day imports are being run down, and higher import costs could eventually be passed on to US consumers, and that equity valuations in terms of price-to-earning multiples are at the top of its historical range. In fixed income, we remain neutral on duration as we expect long-end US Treasury yields to move higher towards 5%. Within DM fixed income, we hold neutral and underweight positions in IG and high-yield bonds respectively, and within EM fixed income, we are neutral on corporates and underweight on sovereigns. We continue to see gold as an effective hedge against inflation, fiscal sustainability concerns, and geopolitical risk. I am Eli Lee, and this is Bank of Singapore CIO Investment Institute.
For more information, please refer to this month's monthly investment guide.